How's it going, everyone? It's Sam. Today, I want to talk to you about 5 stocks that I think are really good long-term holds. The first few are a little bit lower risk, and then as we go on, they have a little bit more growth, and there's a little bit more risk associated, but all of them I think are really good long-term holds. And the reason I bring this up is because I talk about a lot of penny stocks recently. I've talked about a lot of growth stocks recently. I've talked about higher risk investments, and a lot of people have been asking me, what's a good long-term hold? I work every single day. I don't have time to look at the market, catch up on the news. What should I buy just to hold onto for a long time? Of course, I'm not a financial advisor, so do your own research, but I'll walk you through 5 different companies today that I really like. I've owned all of these at some point, and I own 4 of them right now. So if you guys like this, please leave a thumbs up. I really appreciate it. Please hit subscribe if you haven't already done that. We come out with daily videos, sometimes multiple times a day. If you guys want to get in on the action and know exactly when I buy and sell, there's a link down there to Patreon. There's over 3,700 people in there, so even if I don't talk with you all the time, there are 3,700 other people that talk to you, and you can ask questions and stuff, tell them about different ideas of yours, and I tell you my buys and sells in real time on there. And if you want 4 free stocks through WeBull, you can check out the link down below. So they're giving this away if you deposit $100. So the first company that we're looking at today is Berkshire Hathaway. Now, this is a company that's owned and run pretty much by Warren Buffett. So you can see their total revenues here just increasing over time. It's a very steady business. What they're trying to do is just get good cash flow. They're just trying to get businesses that have 8 to 10% growth every single year, and they hold a bunch of different companies. So if you ever look, you can take a look at all the different companies they hold. They own a lot of companies that you would know of. So it's definitely a stable business, and it's one that they've said that since they have so many shareholders that have a disproportionate amount of their wealth in this stock, they just want to make it consistent. Now, if you take a look at their cash, they have 145, this is not million, this is $1 billion here. They have $145 billion that they have set aside just in case. Now, this is a huge amount of money. If we take a look at their total current liabilities, it's about $123 billion. So they still have a lot of money just sitting aside just in case something comes up. Now, the next company is Jpmorgan Chase. This is the largest and really, I think, the most well-known bank here in America. And they have very consistent revenue growth too. You can see, obviously, this last year has been down a little bit for them, but you can see consistent growth before this. Now, they do pay a dividend. This is a company that I'm pretty bullish on because of the fact that they're competing with the fintech companies. They're definitely, I think, the most innovative of the older banks, traditional banks. But they also pay a 3% dividend. They have a really good earnings right now. So they earned, I believe, right around $3.50 last quarter, which was just announced, and it was expected only to have about $2.70 or so. Their net income is pretty high for the cost of the company right now. And again, they do pay that 3% dividend. Looking at their balance sheet, they also have a good amount of cash and cash equivalents right here. Now, the next company is Facebook. So Facebook owns not just Facebook, they own Instagram and WhatsApp too. They are starting to monetize Instagram. I don't believe they really have monetized WhatsApp too much yet. We don't use it really here in the US at all, but there are some use cases for it. Now, it does have a lot of users outside the US, so that's something to take into consideration. You can just take a look at their revenues. They're growing faster than just about any of these major tech companies, and they've even been able to grow this last year, which is pretty impressive. Now, they are cheaper than a lot of the other companies that they face, or a lot of other companies that are kind of in their same size, like Amazon, Apple. They are a lot cheaper if you look at a price to earnings ratio. Now, just looking at their balance sheet too, they have about $55 billion worth of cash. And if you scroll down to their current liabilities, they only have about $12 billion. So they have an insane amount of cash, and they're really willing to put up some money to acquire new businesses. And they're trying to venture out of what they typically do. The second to last company on this list is Walt Disney. So this is a company that's really changed their business model over the last year or so. So they had their parks, they had their merchandise, they had some of their intellectual property. They were a big box office company. Now they're switching over to direct to consumer streaming, which I think is really good for the company because it's very scalable. So they've been able to grow very quickly. I believe they have right around 90 million subscribers, which was their goal for 2024, and they were able to hit that in just over a year. So now they're talking about growing to 240 or 260 million subscribers by 2024, basically tripling what they have now. And that's more than Netflix has right now. And then they'll also have their parks. They'll also have their intellectual property, their merchandise, and everything else that goes along with the company. So I think that this one is a company to hold over the long term because of the fact that they have so much growth. Now, this one's a little bit riskier because of the fact that they do have a worse cash position. They're in a little bit of a bind with their parks, and they are bleeding money on that end a little bit. But right now, I still like it. It's still been going up a lot in price because of their streaming service, and I think that's going to be huge in the future. And as soon as we open back up, a lot of people will be less worried about the parks, and I think a lot of investors will flood to Disney. The last company on this list is Tattooed Chef. Now, this one is a young company. You can see just 3 years worth of revenues here, 47 million, 85 million, and then 136 million. So this is a company that's in the plant-based food industry. It's definitely one that is growing very quickly. As you can see, they just started their own brand a few years ago, but they had been making food for other companies, and they were doing something called private labeling, where these companies then slap on their own sticker, like Target or Costco. They slap on their own sticker, their own brand, but they're using Tattooed Chef food. Now, it had a different name back then, but Tattooed Chef has had experience, and they're growing pretty quickly. They're in 4 major stores right now, and they're still putting their products into more of those stores, because I went to my local Target, couldn't find it, went to my local Walmart, couldn't find it. So they're still growing, and they're growing pretty quickly. Now, the plant-based food industry is also growing, so that's why I think this one might be a good long-term hold. Of course, you're assuming that this industry will continue, and this company has some major competitors like Beyond Meat and even Very Good Food Company, which is much smaller, but this one is much cheaper for the price than those other 2 companies. Beyond Meat's really well known, so I think a lot of people have flocked to that, and then Very Good Food Company was covered by a couple people, and they have a little bit higher growth than Tattooed Chef, but because they got a lot of recognition, a lot of investors flooded, and it's a smaller company, so the share price went up more drastically than Tattooed Chef. So these are 5 different companies that I really like. Like I said, I hold 4 of the 5 companies. The only one that I don't hold anymore is Berkshire Hathaway, just because I have a long investment horizon, so I'm okay with a little bit more risk, and I wanted a little bit more than a 10% return each year. But these are 5 companies that I think can probably outperform the market. Of course, I'm not a financial advisor, so do your own research. But these are 5 companies really to take a look at. So thank you guys so much. If you guys want something like this in the future, let me know, because typically I don't do these videos on like stable companies that have good growth but just aren't as risky. Usually I go for more of the growth companies, but let me know if you like this in the comments down below. Thank you guys for hitting the like button and subscribe and checking out WeBull down in the description below. And if you want to check out my Patreon, it's down there too. Thank you guys. And if you want to see my video from yesterday, I'll put it right up here. Thanks.